Hello everyone. Welcome back to the channel. Today, we're diving into an essential topic in financial management, capital budgeting techniques. This concept is crucial not only for companies, but also commonly featured in exams and interviews. We'll explore what capital budgeting is, why it is vital, and the main techniques used, along with examples for better understanding. Capital budgeting refers to the process of evaluating long-term investment projects, which typically requires significant capital and yield returns over several years. These projects might include purchasing new machinery, expanding factories, or launching new products. Given the irreversible and risky nature of these investment decisions, companies use capital budgeting techniques to assess whether they should commit to a project or not. The importance of capital budgeting cannot be overstated. It assists in the proper allocation of funds, minimizes the risk of poor investment decisions, increases shareholder wealth, and ensures the long-term growth of the business. Now, let's delve into the various techniques used in capital budgeting, which can be broadly divided into two categories: traditional techniques and modern techniques. First, let's look at the payback period method. This method calculates the time required to recover the initial investment made in a project. For instance, if a project costs Indian rupee 1,000,000 and generates 20,000 Indian rupees annually, the payback period would be calculated as Indian rupee 1,000,000 divided by 20,000 Indian rupees, resulting in a payback period of 5 years. The general decision rule here is that projects with a shorter payback period are preferred, making this technique simple and easy to apply. However, it has its downsides. It ignores the time value of money and does not account for profits made after the payback. Next, we have the accounting rate of return, or ARR. This measures the average profit earned from an investment relative to the initial investment. The formula for ARR is average annual profit divided by initial investment, multiplied by 100. A higher ARR signifies a better project. This method is also straightforward to calculate, but like the payback period, it overlooks the time value of money. Now we transition to one of the more modern techniques, net present value, or NPV. Unlike previous methods, NPV considers the time value of money. It is defined as the difference between the present value of cash inflows and the present value of cash outflows. The decision rule for NPV is clear. If the NPV is positive, the project should be accepted. If negative, it should be rejected. NPV is considered one of the most reliable methods in capital budgeting due to its incorporation of risk and the time value of money. Following NPV, we have the internal rate of return, or IRR. This rate represents the return at which the NPV of a project equals 0. The decision rule for IRR states that if the IRR exceeds the cost of capital, the project is acceptable. IRR is widely utilized as it facilitates easy comparison of projects, although it can be challenging to calculate manually. Lastly, let's discuss the Profitability Index, or PI. The Profitability Index measures the value created per rupee invested. The mathematical representation of PI is the present value of cash inflows divided by the initial investment. The decision rules for PI are straightforward. If the PI is greater than 1, the project should be accepted. If less than 1, it should be rejected. This method is particularly useful when financial resources are limited, as it allows for prioritization in investment decisions. In conclusion, capital budgeting is essential for firms aiming to make informed, long-term investment decisions. While traditional methods provide simplicity, modern methods like NPV and IRR offer greater accuracy and reliability. Among these techniques, NPV and IRR are regarded as the best due to their comprehensive consideration of various factors involved in investment projects. Thank you for joining us today. If you found this video helpful, please don't forget to like, share, and subscribe. We appreciate your support and look forward to bringing you more insightful content. Thanks for watching.